All right. Welcome everybody to Midas Investing Live. Hope you're all having a good Sunday afternoon. Here we are again. Hope you all had a good week in general. I know I did. Right off the bat, we'll take a look at the portfolio as we have right here. Last week we discussed a lot of major changes that I made in the portfolio, and I kind of noticed right after I closed out of that stream that day that I had completely forgotten to talk about one of the moves. It was actually one of the ones that I had at least kind of hinted at in the thumbnail for that discussion, which was medical properties trust. So kind of right off the bat, I kind of wanted to comment on that, which was a small position we had. It was a relatively small position, which we closed out of 2 weeks ago. We had taken gains on it, more than half of that position, uh, like a month or two prior to that. So we had kind of already captured a decent amount of gains on a large pop of it, and then it had to come back down on significant more worries related to some of the financing details with one of its customers, which was one of the reasons that the short thesis had been put out for that particular company. But the point is with the recent earnings report, they kind of had put out some details that at least seemed to confirm some of the financial concerns of the short thesis. I wouldn't necessarily say that it backs up some of the more fraudulent claims in there, but the point is we did decide to cut that position. Nonetheless, even though it was basically at cost for the shares that we had gotten rid of when we were finally cutting the whole rest of the position, like I said, we had already cut about half the position sometime before that. So we still had pretty good gains on that. But the point is, for anybody who might have wondered about that, we didn't talk about medical properties trusts last week, and I had kind of meant to. So I kind of wanted to at least give a few comments about that right there. I didn't talk about it too much because frankly, it was one I didn't have that much of interest to say about it, because I thought it was really just kind of a relatively uninteresting position to have. It was just a small value play that we had entered into, assuming that the worries in the short thesis was more than was actually merited. And well, maybe the short thesis was right in the end, but we managed to make some profits off of it nonetheless. Sometimes that happens in markets, but here we are. Some other activities happened this week. We didn't enter into any new positions or exit out of any other ones. Everything's still the same as it was last week, but we're one particular position reported and had a pretty interesting week, which was Hibbett Sport. We did actually add a little bit to that position prior to earnings, but they reported the earnings, and there was some discussion in the Discord regarding that because it popped about 20+%. I think it was 22-23% or so off of its earnings, even though its earnings were really just basically just making expectations for the most part. And some of the people in the Discord had also commented that the inventories are still relatively elevated, and sales are still dropping, and margins are still dropping, and still not necessarily a super great position. But it just goes to show that sometimes companies are just that cheap, that even if they just make their expectations, that they can get a ridiculously large pop in their price just because the market sentiment was that negative. And I had been buying into a little bit of that position off of the negative sentiment that week, because of all the other retailers that have been dropping over the last week or two, from Foot Locker to Dick's Sporting Goods to a variety of other retailers of different categories. But the point is even with some social media videos surrounding Hibbett in particular, with some retail theft, some videos of people taking some merchandise out of their stores and literally walking right out of it. In my mind, I'm still looking at this as that's just one piece of noise amongst all of the data. So I decided to buy into it. But hey, that could have been just as regrettable. It could have gone down just as much. Some people don't like to buy before earnings. I frankly don't really pay too much attention to whether earnings are coming up or not. I'm just trying to buy every week, and I look at what I think the opportunities are or will be. And so Hibbett was just, I guess, the one that we chose to go for that week. We also did add to PayPal, as we've continuing to being adding to this position. Also added a little bit this week to Advanced Auto Parts, which has also been declining a bit more this week. And as some of the sentiment is continuing to grow even more negative for them. And then also this week we did a lot of research into some of the macro details surrounding some of them, our other positions. We didn't add to them, that being our copper positions, our lumber positions, and our gold positions, our commodity positions, so to speak. But over the last month or two, I've obviously been diving more and more into commodity data and sharing that on the live streams. But the point is I've been kind of going even more in depth with that. We had a show dedicated to oil in the oil markets, and kind of covering a lot of the details surrounding the production and consumption of oil in particular before I had a little bit more of a broader commodity show. I'm planning to do a little bit of a more focused show on some other commodities as well, in particular copper, because that is one of the commodities that I do have exposure to, as well as I'll probably cover lumber and gold in a little bit more of a dedicated show. I'm expecting the copper show basically to be next week, so you guys can kind of expect on that. Normally I don't necessarily have the live shows to planned in advance, but I guess what with the, like I said, the research I've been doing this week, I've been kind of preparing for a ring of different shows going on in the future. And particularly what I mean about that is that I had um, as I had said before, I had done a kind of a larger exploration of consumption and production data surrounding the different producers of oil and gas, and I had made some charts surrounding that. But I've been making similar data sets for copper, as you can see here, as well as, like I said, I'm doing similar for gold and lumber and other places. And that's surrounding some of the economic data driven regression models that I've built up for predicting copper prices for the future. And with oil, I had then combined those estimates from my regression output with estimates from a variety of other locations, which I've been trying to collect for these other commodities as well, which unfortunately hasn't been as easy as with oil. It seems that there's more entities out there, consulting entities, economic entities, or what have you, that are making predictions about oil prices 10 years from now than there are making ones about copper prices 10 years from now. So far, I've only really been able to find some estimates from the IMF as well as the ISA. I wasn't able to find some from, for example, the World Bank or McKinsey or Deloitte, which were some of the ones I was able to get oil estimates for. So still looking for some more outside estimates to compare with to then build up essentially a distribution of copper estimates for the future. But the point is, I'm trying to use the same methodology I use for oil through and through for the other commodities. In the short run, I had been relying just on my regression outputs that I had created. But with oil, like I said, I had combined my own outputs with estimates of other people. So I'm trying to do the same process all around surrounding as many of the commodities that I plan to at least try to get exposure to. I probably won't use that whole process surrounding all of the commodities that I've been making statistical models for, but at least the ones that I'm trying to get exposure to, which I already have exposure to: gold, as well as copper, as well as lumber and beef, chicken, and pork through Tyson. And then as well as I technically have exposure to silver through both my gold producer and my copper producer. Both of them also produce a little bit of gold and silver as well. Uh, Often just you can find them in similar locations sometimes. So anyway, beyond that, the main topic I kind of wanted to talk about a little bit today is really just talking a little bit more about interest rates in the Federal Reserve and Jerome Powell. The Jackson Hole symposium happened this week, and he came out on Friday with a relatively brief speech, basically the same speech as he gave at the previous one, and the same thing that we've heard over and over again, which is him saying that he sees inflation as much too high still, and that he still has work to be done, even though he has acknowledged that they have made a lot of progress. And I know I have generally been cheering that speech every time I hear it, because I generally agree with it, and have agreed with the whole time. But I know that the market has definitely become a little bit more and more, I guess you could say, impatient with Jerome Powell as they start to see the effects of the interest rates starting to take its toll. And I definitely agree and understand why people are concerned about these things. And some people are really looking at the inflation gauges and the inflation numbers and starting to say, well, hey, by what measure can you actually argue that we're still at high levels of inflation? So that's one thing that I wanted to take a look at, was kind of the gauges of inflation that we've been looking at, and kind of comparing like how you can think of something as high or not necessarily. Jeff, yo, what's up? Welcome. I will say before I get into all that, Jeff commenting here kind of reminded me, if you're watching either live on the replay, please like the stream. It really helps us attract more viewers to the channel. Subscribe to the channel if you're not already. Whether you're watching live or on the replay, also hit the notification bell to make sure that you get notifications whenever I go live. You'll also get notifications when I put out other videos, my valuation videos, which, for the record, I'm expecting to put out a video this week on Encore Wire. So you guys can expect that on Friday this week. But about every 2 weeks, we have a video come out. Jeff, thank you. I see that. Yeah, you're doing your duty. Thank you very much. Also, if you guys are watching live on the replay, you can consider joining the free Discord. The link is in the description below. It's also the pinned comment in the chat. And join and become part of the daily discussions of what we've got going on in our portfolios, what's going on in the markets, analysis of various companies, the actions of various investors, random uh, articles on how learning to invest, discussions from major academics, things like that. Come be part of the daily discussions there. Jeff, I keep hearing that lower oil prices are harboring inflation, but essentials are sky high. Weighted average, I guess, going out to dinner or the grocery store sucks. LOL. Yeah, if you're basically saying that like the weighting of the energy within the inflation categories are kind of like making it seem like it's lower inflation. I'm assuming that's kind of what you mean, because we have had generally lower oil prices. That has been a huge part of the effect. Whenever they're calculating the year-over-year number for inflation, so like this thing that I pulled up right here is a good way to kind of break that down. Let me move my head. So the blue line, we have the year-over-year inflation, and this is CPI first off. So the year-over-year number, and it's over on the left-hand column, the actual number. So obviously we peaked around 9% or something like that way up here, and now we're down close to 3.3%. Now the red bar, what I have there is the month-over-month movements at each of those points in time. So it breaks it down and we get rid of the abasing effects. We're just looking at the month over month movements. And then the yellow line is the median or average. I can't remember which one I actually used, if it was the median or the average, but either way, it's some sort of central tendency point of the month over month movement. So you can get an idea at any given month whether or not that monthly movement is considered large or small relative to the average over this 10-year period. And it is specifically looking at this 10-year period, you'll see where the average is. So you can see that the month over month movements have come back down to, or the CPI, relatively close to where the average is, but they haven't really been super below average, enough to make it so that we're still kind of above average. So if you're going to get CPI back down to some sort of average level, you would need to have about half of these red points below the yellow line and about half of them above. That would be getting you to an average number there. So I'd say like over the last 3 months, you can see that we've kind of been at about that spot. So over the last 3 months, you could say that we've been at about average CPI levels. But if you're looking at the year over year number, you still have the other 9 months baked into it. So for the next 9 months, they still have to get rid of that. And then plus also, like I said, they're going to want to maybe have a little bit lower under the line as well, a little bit with it. So the basing effects really throws this off. And again, this is just CPI. This is one measure of it. I have also the PCE with basically the same concept played in right here. You can see that the kind of average month over month for the PCE, the core PCE, is 0.17 there, and you can see the month over month numbers are way above average for the PCE. So like, what's the difference between the CPI and the PCE? It's going to be those energy and food costs that you were talking about. So like you can see, like when you're looking at the last 3 months of the CPI, it looks like we're back to normal. But if you're looking at the PCE, which is core services and stuff, we're still way above average, and we've been way above average. It's coming down. It's still coming down, but it's coming down much slower. So it's definitely just one of those tricky parts to it. The last comment you said there, I struggle with the balance as an investor. I do not want deflation, but as a consumer, I do. Prices will never go back. Monetary supply grows at plus 7% per year, and it feels like it won't stop. What would happen if you deleted that super low trough in 2020? Would it skew differently? I am not sure which one you're looking at. There's kind of troughs on both of them, so I'll kind of assume it's the same for both of them. That would skew it a little bit, I would say, but I would also point out that we have all of this upper section right here that's in the average as well. So I would say that there's skews both directions. You can argue about whether or not to include skews. I just include the whole figure to keep it relatively simple. But you could definitely argue about removing skews. But like I said, I also included the higher points. So you could argue that this is maybe a little bit high because of some of the higher points at any given point. But anyway, like I said, you could also make slightly different arguments for the different measures there. But yeah, so the point is, looking at like I said, the core PCE number, we have not come down that far from it. And it even on the last 3 months, we're not coming down that far necessarily. We're still way above it. Not quite double where it needs to be, but still significantly above it. Then there's the other measure that the Fed has grown very fond of looking at, which is the services less housing. Now they're talking about the core services less housing, and this is specifically just CPI services less housing, as I had difficulty finding the core PCE less services. They have kind of like their own internal ways of being able to calculate it, so it's a little bit difficult to get the exact number they're looking for, but nonetheless, this is still a less housing figure that gives you an idea of it. So this kind of shows just how much it skews downward if you remove the housing effect. It actually gets you to arguably starting to deflate levels for the last 2 to 3 months or so, when you're specifically looking at that less housing figure. But then again, housing is a key measure, right? It's not like you could ignore that. Well, how many people rent, and rent is about 30 to 40% of their disposable incomes, right? So it's something that, you know, you can't necessarily just strip away all the important things. I know the Fed likes to say, like, oh, let's strip out food, oh, let's strip out energy, oh, let's strip out housing. It's like, okay, but what are you even calculating at that point, right? I agree that there's some usefulness to paying attention to these measures, because it kind of gives you an idea of what certain aspects of the economy, but at the same time, what we feel is basically still everything, one way or the other. So yeah, I don't know. The point is from some measures, you can definitely argue that we're getting really, really close to the end of the road. That's kind of the point I'm trying to show here, is the CPI and the CPI services less housing both look like we're either at normal average levels or possibly even starting to deflate, whereas the core PCE still makes us look like we're still way above average. So you can kind of pick your inflation measure to make whatever argument you want to make there. All we have to do is include price drops in big picture big screen TVs and give it the same weighting as energy and services. Recession solved. Boom. Done. Yo, what's going on? Yeah, no, I mean, obviously you're kind of pointing to a specific point there, which is to say that the way that these are weighted makes a huge difference. So you can argue that the way that they've chosen to weigh things has an effect on some of these things, because some of these weightings are made at some points in time, and sometimes it's political reasons why they change the weightings and stuff like that. So anyway, I want to get to one other interesting point. We've kind of looked at this table a few times in the past. I haven't brought it up in a while, but this was the table I was putting together when I was kind of trying to make a projection of how far I thought the Fed funds rate needed to go. I was using this back when we were still in like Fed funds 4% range. I can't remember when I first brought it out. I might have still been in the 3% ranges or something. But what we were doing here is I'm comparing nominal yields, and I have the nominal yields at the start of the tightening cycle, which was the end of 2021 here. I have Fed funds rate up the curve all the way to the 30-year treasury, and then I also included the 30-year mortgage. And then I keep track of the current rate for each of those. And so you can see how much the nominal rate has changed for each of these measures. And then I compare that to the CPI at the start of the tightening cycle versus where the CPI is currently on a year-over-year basis. And then I also do the same thing for the core PCE. And then I subtract the difference. So we get an idea of what is the real yield at the start of the tightening cycle for each of these. You can see the real yields across the range of CPI was massively negative. On average, we were talking negative 5.8% as a real yield at the end of 2021, versus like for right now for the CPI, it's a real yield of on average 1.9% across all of these durations. And then for the core PCE, for example, you can see it was a real yield on average was negative 3.8%. And then right now the core PCE real yield trailing would be on average 1.1%. So we've gone from massively negatively yielding securities towards positively yielding securities, which shows that we are in fact tightening. That is quantitative tightening. That is showing that there is actually restrictive monetary policy in place, because we actually are now essentially pulling money out of the consumer system by having it parked in an interest-bearing place. Now we compare these averages over time and then use the ratio of how these averages have changed to then get an idea to say if we want core PCE to get back down to 2%, and we're currently at 4.1%, well, then that means we have to have 2.1% of core PCE still needs to change. And then I make an adjustment based off of how well they performed over the time to say, well, we probably don't need to actually have 2.1% of Fed funds rate changes because of the fact that the tightening effect is already in place. So I adjust it based off of how much acceleration we've already had. And I argue that we would need about 0.4% of Fed funds rates still in order to successfully tighten all the way back down to 2%, which means that we would need the Fed funds rate to get up to about 5.8%, which would mean about 2 more meetings of about 25 basis points per hike. I think last time I showed this 3 or 4 months ago or something like that, it was saying that the terminal target we need to get to was 6.25%. So and then we skipped a few meetings. So it would show that my previous estimates were perhaps an overestimation. Maybe I was underestimating how much the lag effect and the accelerated tightening effect would minimize the need for future hikes. And so off of that basis, maybe you could argue that I'm still wrong here too. Maybe we're at a terminal rate that is sufficiently tightened enough. But at the same time, this model still says that maybe we could expect 2 more rate hikes. I don't know if we'll still get those 2 rate hikes, but I don't know. We'll see about it. It kind of feels like J Powell wants to be done, but doesn't feel like he actually is done. So we'll see if it actually happens, because there is sort of the political factors to take into account too. This is strictly looking at real rates of return and trying to take an estimate based off that. That's just one way to kind of think about this. And there's not necessarily even that strong of an argument to say that this is the right way to think about it. So but I would argue that I was pretty close. I would argue that considering where we're currently at 5.3%, and the fact that J-Powell's still signaling that we have maybe 1 to 2 to go, that would get us to like 5.5, 5 7/4 or something like that, depending. And I was saying 6 to 6 and 25%, back when we were at like 4% or something like that. I feel like I was a lot closer than the other people who were still saying that we only had like 1 or 2 meetings ago way back then. So, you know, not precise, but perhaps still reasonably accurate. Jeff, I read a lot about QT, but it fails to understand when it will ever affect the actual balance sheet / money supply. Any ideas? I get that companies can't get the same funding and could get less, but when they do, they actually delete the attendees. Yeah, well, so this is the thing. I've listened to a lot of macro people talking about this over the last few weeks, and yeah, it's a little bit complicated to figure out when the tightening affects, because everybody's balance sheet is different. Everybody has a different financing setup, and that's basically what it boils down to. Is that when you're looking at a different company, they all have to pay back their debts at different points in time. And so if your debt is financed till 2024, then that means you only have 1 year in which to possibly try to find a cheaper interest rate before you're going to be forced to roll over your debt into the higher interest rates. But if you manage to finance your debt out to 2030, well, then you can basically just ignore this whole discussion through and through, right? So the question is like, what's the weighted average maturity for the debt within the economy? And I've heard different measures, different people have slightly different estimates of it, but in general, the weighted average debt maturity is like 2 to 4 years, usually quoted closer to that like 2 to 3% range more often than not. But I've heard some people even say numbers closer to 5% or 5 years. I'd rather not 5%. Jeff, sadly, everything I've heard is that the space we run in small / micro are the ones affected the most. Yes, that is definitely the case. Bigger companies have better credit ratings. Better credit ratings are going to have better access to capital all the way around. And credit rating is just a proxy for all of the figures that matter, but I'm using that as our easiest way to talk about it. So, you know, that works about it. But yeah, definitely. That's part of the reason why we call them economically sensitive. And that's part of the reason they get the returns they do, right? So it's a part of the deal, so to speak. Raindrops, hey ho. Yeah, welcome Raindrops. Haven't seen you before. Welcome to the party. RIP Medical Properties Trust when it comes to maturity. Medical Properties Trust is a perfect example of this discussion. Is that they're financing debts with some of their own customers while they themselves have very, very sensitive maturities on not very, very great interest rates, which could lead to worse scenarios. So yeah, definitely part of the reason I got rid of it. Here, hold on 1 second. I'm gonna let my cat into the that is gonna be super loud if I just let him in. Jeff, hey Midas, I know I was late. Did you do your portfolio discussion in that time? Yeah, I kind of overviewed a little bit of the portfolio kind of at the start. There frankly wasn't too much to talk about. It was he mentioned their raindrops that I was medical properties. That was one thing that I talked about. Frankly, I had kind of forgotten last week to discuss them. I discussed all the other moves in the portfolio, but I had forgotten them, frankly, because they were just one of the lesser interesting parts of that discussion to have. But I did cut out of the medical properties position entirely over the last few weeks, or a week and a half ago or something like that was when I cut out of it. Frankly, I got into that position because I thought the sentiment was much too negative on the short thesis. I thought that they weren't likely engaged in any fraudulent activities, but that there was still financial concerns surrounding them, and I just thought that the financial concerns were overblown. But with the most recent earnings report and the fact that they are continuing to extend further credit to their own customers while they themselves have credit issues, just further backs up, I think, some of those financial concerns at least. So I definitely decided to say, you know what, screw it, we'll get out of there, even if it isn't at super great pricing. Still overall took profits on that whole move throughout it, just not necessarily super great profits. I did add more to AAP, a little bit more to PayPal. I've been looking at InMode, that one coming back down as well. But yeah, that was basically kind of the overview of that discussion there. And I mean, back on this inflation discussion, I mean, I pretty much finished up with all this. Like I said, is like, long story short is that, my terminal assumptions based off of the tightening and the real yields is to argue that we would still have maybe 1 or 2 rate hikes to go. I was arguing that that we still had a few rate hikes to go before we started the pause. So who knows, maybe if we just pause for an even longer period of time, that would get us the job done. But this model doesn't assume that we have to hold it for any period of time. It basically just assumes we have to get it up to that period, and then we could start to cut it back down. So who knows? The point is maybe if we just leave it at where we're currently at and leave it there for 2 years or something, then that might get the whole job done. Jeff got into PayPal. Nice. I don't know what to do. For the first time since I tried, it's slightly green. Panic. Yeah, I mean, it's always difficult when positions go up immediately, right? Like, what am I gonna do with this position? That's not how this is supposed to go. I'm supposed to lose money before I make money. WSM had a pretty nice quarter for their depressed price, in my opinion. Had a nice 14% day. Yeah, they might have been dealing with a somewhat similar situation there on all of the negative sentiment surrounding all of retail. Man, retail was just getting hammered. Everything that had a brick and mortar store was just getting hammered. And I mean, it's true. Part of the concerns with that was surrounding all of the retail theft and stuff like that, which is a growing concern. But one of the things I actually shared it in the Discord when somebody asked me about my kind of bullishness surrounding Hibbett, which I had added to this week prior to their earnings, and they got a big pop, which was to say that even if Hibbett themselves is experiencing theft, it's not like all of their stores are being stolen from, right? It's like, yes, there is a large growing criminal element in retail spaces these days, but it's not like every single store of a retailer is getting hit simultaneously. Even if they have like crews hitting multiple stores in an area or something like that, it still might just be a few stores in an area versus the thousands of stores they have over the cross of the country or something like that, right? And then also, it's not like they can hit all of corporate America simultaneously. So it's like, even if everybody in corporate America has a theft problem, how many of their individual stores and what percentage of their revenue is that really going to affect? It's one of these, I don't know, it's one of these things where it's like, the anecdote isn't the data, right? If you see a video on YouTube or TikTok or Twitter or whatever showing some people robbing a retail store, you got to think critically about that and whether or not you really think about that as a real concern. Just in case I get lost, I'm with you in adding to PayPal. I'm up to half the desired position now. Oh, okay, interesting. Yeah, I did miss that before. Yeah, I'm definitely still looking to add to PayPal. It's definitely been dropping a little bit more this week. I think, and this one also I think was getting some of that negativity surrounding retail, though obviously it has other elements of its own negativity. But I definitely think of AAP as one that's not going to have that type of concern, not a retail theft type of concern as much relative to other ones like, say, Hibbett. It's much easier to walk out the store with apparel than it is with auto parts. And auto parts, a lot of that stuff is behind the shelves, though. That's all of it. AAP, not PayPal, but both. Yeah. Okay. Yeah, that's kind of what I assumed you said there. So yeah, coming over to the CME Group website, we can take a look at the kind of the rate probabilities as it currently stands. So the market is still definitely not really expecting too much of a hike in the short run. 80% is still expecting us to leave it at where it's currently at, despite the Jackson Hole meeting. So we'll definitely have to see what happens with that. One other thing that I thought was kind of interesting, that is one argument for why you could maybe forego further rate hikes and just allow for the current level to carry the tightening forward, is the kind of reaction that we're finally starting to get in some of the longer term rates.
which is something that I kind of put it in the thumbnail. Comparing right here, we have the orange line is the federal funds rate, but then here we have the 10-year treasury. So the 10-year treasury was going up with the rate hike cycle pretty consistently up through about October 2022, which is around the point where the market started to turn around. And at that point, basically the 10-year was like, you know what, I think we're done. We're done at 4.25. That's kind of about as far as we're going to go. In fact, I don't even really want to stick to landing at 4%. And it's had difficulty ever getting above that 4% line ever since then. But we've kind of really had a pretty solid breakout above that 4% in the short run. We'll see if it pulls back on that or not. That's definitely one thing to argue about. But the point is you can see is it's starting to follow up to the federal funds rate. It's like if the federal funds rate doesn't come back down, maybe it stays there all the way through 2023, all the way through to 2024. Well, then I expect that you would see this start to happen here, which, by the way, this happening if the 10-year treasury, if the federal funds rate stays flat through for a year and a half, and then the 10-year treasury then goes above it, that would be us uninverting. That would be an effective uninversion. As I was talking about a week or two ago, I was saying that like when people talk about uninversion or the inversion, the question is about how and when it uninverts, because it can uninvert because the short-term rates come down, but it can also uninvert because the long-term rates go up. And the reason long-term rates would be going up is because there is one of two things happening there. Oh, whoops. What happened? Oh, it popped the thing. Hold on. I screwed up. There, I don't actually need this chart anymore anyway. Coming back over to the thing, the argument people have about this is that we're going to be getting rid of that we're going to have the short-term rates come down. That's most people's argument about why it's going to be bullish, is because short-term rates are going to come down. But if long-term rates go up, then think about what we were talking about before in terms of people having to roll over their debt. If you have to roll over your debt, but the long-term rate has gone up, then that means that even if you're rolling over your short-term debt, it's going to be built into the long-term debt. So that's going to make the ability to roll over the debt into short-term rates impossible if the long-term rates continue to move up over time. So yeah, it's definitely one thing that I would be very, very concerned about, is like we don't necessarily have to have the federal funds rate continue to move upward if the long-term rates finally start to capitulate and move upwards. And I say capitulate because obviously that would be bond prices coming down. It's actually the prices coming down that makes the yields come up. So if the yields are going up, it's effectively the bond traders capitulating to the fact that their short-term belief that the long-term was never going to change is going to be wrong in that sort of sense. So definitely huge concerns to be paying attention to. Even if we don't continue to rate hike, we can still have a lot more pain to the economy, as you were just talking about the smalls and the micro cap companies, the companies we pay attention to a lot more. Those companies would then have to roll over, even if they were trying to roll over into longer term maturities. They themselves would then have much higher interest rates on those maturities. So that's pretty much all I wanted to talk about in terms of like the rates, and then the Fed, as I was talking about. It's like we still have some time before we get to the September meeting, and we have some more economic data that come out before then. And then, as I was just talking about, it's like it's very possible that he'll just leave rates where they are and just leave them longer, because that might be the more popular thing to deal with in the time for the time being. So it might be that the Federal Reserve is going to stop being interesting to talk about, and then at that point, it's just going to be a question of what's happening to the companies in the economy, and more and more companies if they start to go bankrupt. So now I guess at this point, if you guys want to start talking about some tickers, we can start talking about that. Let's see, as I was kind of talking about at the start, I am expecting to do an Encore wire video this week. That's on the docket, and it kind of lays into the discussion that I was talking about related to copper. I was doing my kind of overview of copper data in particular, first and foremost, which I'm not really talking about too much of it here today, just kind of discussing that I've been doing it. But next week's live stream, I plan to do a little bit of an overview of the copper markets, and that's going to be very much related to the model that I've been building for Encore Wire, because copper is pretty much the most important input cost for them. They themselves are not a copper commodity company, but huge portion of their costs, about 60% of their costs, is related to copper. But we are very interested in direct copper producers as well, so we'll have to see about that. Tickers, start dropping tickers. That's where we're going. Raindrops, Ranger Energy Services. Which one is that? Let's see here. Ranger. Let's take a look. 300 million market cap, 325 enterprise value, so a little bit of debt, but not too much, it looks like. No dividend. Gross margins trailing 18%, EBIT margins 6%, return on assets 6.6%. Forward expectations of revenue growth is pretty positive, along with their profitability metrics are expecting similarly. Relatively small short interest. Okay, so basic figures are looking pretty solid right off the bat. We can go dig in a little bit. Well, actually, let's take a look at those estimates first and foremost. Yeah, so about 650 in revenue expected this year, maybe pushing up to close to 700 next year. How many people we got on that? 2 people. They've announced a dividend next quarter. Interesting. Okay, very cool. That could be very nice for them. They look really cyclical. When things are bad, horrible, so many negative free cash flow years. Oh yeah, bad me. Looking at those forward numbers and then not actually reading the little descriptor thing. Should have done that before I even moved away. But yeah, let's take a look at what they actually do. Energy equipment provides onshore high specification well service rigs, wireline completion services, complementary services to exploration and production companies. Okay, so equipment and servicer to E&P, which yeah, E&P itself is already cyclical. So imagine being part of the capex cycle of E&P itself. Yeah, cyclical upon cyclical probably. But hey, well, we'll see where that takes us. High specification rig segment offers well service rigs and complementary equipment and services to facilitate operations throughout the life cycle of a well and well maintenance services. The segment also has a fleet of 420 well service rigs. Wireline service segment provides wireline protection and intervention services to provide information to identify and resolve well production problems through case loggings. Interesting. Segments of fleet processing solutions and ancillary services segments rents well service related equipment consisting of fluid pumps, power swivels, and well control packages, hydraulic catwalks, and yada yada yada. Others. Okay. Yeah. So yeah, just kind of a general equipment company, but very specialized within that industry for sure. So yeah, coming back over to those estimates, let's take a look. Take the EBIT. Yeah, so pretty large accelerations in EBIT expected while maintaining relatively low margins, but still higher margins than we've had in the more recent past. But this is also based off the estimates. Let's come back over to the regular financials. We only have numbers going back to 2015. Let's look at the ratios, gross margins, EBIT margins, unlevered free cash flow margins. Yeah, very rough. The gross margins are relatively stable, a little bit down in the more recent couple years. I'd be curious what's going on there. The EBIT margins definitely coming up though. That's what we like to see. Still having some negative years though. It was some super negative territory. Free cash flow is a little bit of a nightmare, but to be expected considering it's where it's going. It's very small. Let me come back over to the income statement. Yeah, so total revenues have been growing up pretty rapidly, so we can kind of give them a little bit of a break on that coming up into profitability terms because of the fact that they're clearly on the growth trajectory. And you know, we were seeing still growth expected for the next 2 years, which is still really low growth comparative to this. That's one thing I would definitely point out. But hey, it's still after reaching this peak level though, so if they can stick that landing, would be like, you know, accelerating up and then leveling off rather than collapsing back down like this, right? So it's, you know, not amazing to come down to 7% growth rates after this, but it's possibly that they're just leveling off before the next takeoff point, right? In terms of growth. So I can give them a little bit of a break in terms of those EBIT margins because they clearly are on that type of trajectory. Let's come back over to the ratios and take a look at balance sheet. growing in terms of the liabilities as a percentage of assets a little bit over time. Not in bad territory. We're still only in like the 30s to 40s, still only like 30s 40s range, so not bad at all. But perhaps something to pay attention to is that that's starting to tick upward. Cash conversion cycle, let's see what we got on that. Cash conversion has definitely been accelerating upward too, but you expect to have cash conversion starting to grow when you're growing. That's how I usually see it. It's usually once you level off, you start to hopefully have the cash conversion come back down a bit, um, or whatever. So also something that's not a worrying sign, nor is it even huge. Like that's actually really low cash conversion number to begin with. 60 days is not a long time to wait for your cash. So honestly, it's not even a bad number to begin with. But the point is just a quick one boil way of looking at through everything. So I mean, yeah, I mean, as far as a growth play, it looks like a good company with a good potential in front of them. The question would be about how sustainable is that growth path continually, because obviously it doesn't look like they've super stuck the profitability landing. It looks like they're kind of maybe about to stick the profitability landing, but not maybe quite there exactly. So it's one of these things where it's like, yeah, it's like maybe they're there, maybe they're not there, hard to say. So let's take a look at where they are in terms of the market. If we can find a good period to look at them. Yeah, not much to look at, but averages over this at least 2-year period, 8 to 9 are currently at like 6 to 7s. Obviously that's with much lower growth rate. So keep that in mind that it was being priced like this. Well, actually let's come back here to like past. See, so we had high multiples back here when it was in bad profitability range, but they were expecting profitability to grow quite a lot back here. So you can see why it's like they were getting some higher multiples up at some points way back here, but then they were coming back down to these low multiple points. So just because we're at low multiple points here doesn't mean that we're not maybe still gonna maybe get some spike ups possibly there too. Yeah, so. Yeah, I was ignoring a couple of you guys' comments there, but it looks like you guys are answering your own question a little bit on there. Have a drill company same space. It's basically oil related. Personal opinion on rangers that were at the top of the cycle. Yeah, that's one thing I would be concerned about. I don't know if it'd revert, but I think it'd be investing in when things look horrible and their EV to EBIT are terrible. Yeah, see, that's like one thing that's kind of confirms with this is like I'm willing to bet that the best points to buy are actually right here, right? Like these are probably the better points in time type. Let's take a look at it. So like end of 2017 through mid 2018, end of 2019 through mid 2020, right? Let's come back over to overview, look at the price chart, all. Oh, well, this is only going to give us one of those periods of time, but end of 2019 into 2020 was down here. So this would have been at least a pretty solid point to buy. We don't have the first period of time, unfortunately, for that that time we were looking at. But yeah, like so, like the high multiple period was here. This was the high multiple period, right? That was the point to buy in at least this very short sample size of time that we have to look at on the price chart. But then that's often the case for cyclical companies. Cyclical companies usually you have to do almost an opposite approach to it. And I'll be the first to admit that I screw this part up all the time. And I do it intentionally. Well, I mean, not intentionally, but I know that I'm screwing up when I do it is my point. I buy low multiple companies in cyclical industries all the time. I do it all the time. What you're doing is you're making a bet on just how much of those earnings are going to drop out from under, right? And oftentimes you want to jump in after the earnings have dropped out. That's the point. Yeah. So the point is yeah, you could argue that we're in a similar situation right now, with this kind of lower multiple time frame. It could be better to wait till the earnings drop out. Obviously that's difficult when the estimates don't believe that the earnings are actually dropping out, which is part of the reason you have a forward estimate, because keep in mind these are forward estimates. So yeah, when the forward estimates are low, that's when the earnings are very possibly actually going to be negative. And then you also get the best positive reaction from the dual upside. Yeah, and then what you guys were also saying, yeah, I was looking at a liabilities ratio. I like to look at the liabilities ratio because it it just answers the question simply, right? It's like I don't have to worry about whether or not they classified their debt in some weird way or something like that. Just look at liabilities as a percentage of assets, and then you know the total capital structure. It's like who cares? It's liabilities. You have to pay it back one way or the other. I don't know what it is. Technically, it might include like deferred taxes, which isn't like a real liability, but you know. So, but it gets you pretty close to the answer without having to look at debt. So yeah, maybe they don't have any actual debt, but they do have liabilities. They have liabilities. That's the point. They might, and those liabilities might even be relatively safe. Like I said, we could look and take a look and see what their actual liabilities are. It might be that these liabilities aren't really a huge concern. Capital leases. See, like they do have capital leases, which is not debt, but it's debt. Like that actually is debt technically. And then they have accrued expenses, which is bills that they haven't paid basically. So yeah, I mean, and then accounts payable, which is stuff that they haven't paid for yet. So, you know, it's not like it's relatively minor liabilities. It's not like a big deal, but it is stuff that they're going to have to pay back nonetheless. So that's why it's like, I just look at that. Gets it done in one job. So yeah, I will say overall, my impressions of this company is that I definitely think it's an interesting company. It looks like it could be on an interesting growth path, but I can't necessarily say too much myself about it. I will say that, yeah, it does look cheap, but looking cheap could be an illusion. That could be the mistake. And based off of some of the points in the past, that seems to be a good argument. So what else do we want to look at? Dilution. Oh, I didn't pay attention to dilution. They've been diluting. I mean, that's kind of what I might expect considering they're growing. And also what we saw on the chart was that they had their stock start in 2018. Even though our numbers are going back to 2016, I don't know, that might be their first listing. So it's possible that what you're seeing as dilution is actually their IPO. That might be what you're looking at. But yeah, common stock issuance in general, we're seeing some serious common stock issuance, and then the very, very small common stock issuances in follow-up years thereafter as well. Liabilities line. Oh wait, my bad. I was totally on the wrong line here. I'm like looking at this like, wait a minute. I meant to be on the cash flow statement issuance of common stock. My bad. Totally wrong spot there. Like, wait a minute. That's the common stock on the balance sheet. Yeah, issuance of common stock. We've had very, very significant issuances year after year, which is how they're going to get their capital, which by the way, leads to like kind of back to the interest rate question we were talking about before. It's like, this all leads into the credit evaporating from the markets, right? It's like interest rates are up. That means if interest rates are up, you can park your money and you can get that interest rate. So would you rather issue stock to a very, very small company that may or may not be profitable as it continues to grow, like Ranger Energy Services, and maybe over time you will get 20% annualized returns or something like that, but maybe you're going to get no returns for the first 5 to 10 years, right? Maybe you'll get 20% returns, but maybe you're gonna have to wait a long time to get them. But you could get 5% today. Would you rather get 5% today, right? And then who knows? Maybe if the 10-year rates start to drift up and suddenly the 10-year rate gets up to 5%, suddenly you could buy a bond and you could get 5% for 10 years. Would you rather loan to the risky Ranger Energy Services? Maybe you would. Maybe you would rather risk it and try to go for those 20% returns that aren't going to show up for like 5 to 10 years, maybe, right? So it's one of those things where it's like, this is the reason why people are going to be stuck in situations like this. Like, why are you issuing capital like this? Why wouldn't you issue debt? Because debt's going to put you at higher risk of default. But this is another form of capital issuance, right? So it's like issuing stock is similar to the debt question, right? You could issue capital in the form of stock, or you can go get your interest rates, right? It's all related into it. So here's a company that looks like it's reliant on common stock issuance in order to fund its growth path. It's not going to be able to grow if it can't get the capital, and it's not going to be able to get the capital if the bond investors or the banks that do the stock issuance are more interested in getting the interest rate than they are funding new capital investment. So definitely a difficult question. That follow-up question you had there might be worth discussing. CSIQ for Mr. Beast. They tanked hard on a second illegal dumping fee. EMPH and others in the same industry are in shambles. Yeah, we did mention the drop in the Discord briefly, or I mentioned it when I saw that it had happened. and I had pinged at him a little bit, saying that, hey, it looks a lot cheaper now. But I did also comment in there that I didn't know why it had dropped. So good to get that follow up. I'd have to look into that. An illegal dumping fee. Yeah, I might have to look into that. But yeah, let's go over to the value dashboard, more to the potential page here, and then take a look. Yeah, CSIQ. For some time there, it looks like I had it like, it looked like it was maybe 10% overvalued or close to fair value depending on the week. But in here it dropped recently. How much did it drop over time? I can't remember exactly how much. You can go pull it up. Oh well, I'm still having this I don't know what happened that I pulled the bar down here, but it locked it down. But I don't use this website as much as some people do, so I'm not as good with keeping the stuff of it. But here, we'll pull it up on here. I need to figure out the settings on TradingView, but we'll put CSIQ in here. Raindrops. I'm basically agreeing with you. In addition, I was wondering how they keep up with some of their competitors, like Baker and Halliburton, because they're so small. Yeah, well, I mean, like I said, I only read their little brief description there, so I'd have to go into their filing and really kind of get a look at what it is that they think gives them a competitive advantage. But based off of the description they have there, I imagine that they have very, very specialized equipment relative to maybe some more generalized equipment. That's usually how small players can make themselves relevant to specific customers, is like by being the only one providing a specific type of machine, and then by building that relationship, they can then parlay that into some other options. I don't really know specifically what would be the case for them, but I imagine it's something like that. I would have to go looking through their 10K, but based off of the little description that it had on the overview, the little company profile, they were really are kind of arguing that they have very, very specialized equipment, whereas like Halliburton really does make equipment for all sorts of stuff, and Baker, though they are very large players, so that is a very important question to ask. What's going to give them the muscle room competitively? Jeff, you followed up and said, I don't think they compete. Probably have a nice set of loyal customers. Yeah, kind of following with lines up with what I was saying. But the purpose should be to be acquired, which that could definitely be an option for them. They got the route. I think that's the only way smalls can win versus the bigs. Well, I mean, I don't think it's the only way that smalls win versus the bigs. I think that smalls can just win. There are plenty of companies that are big today that were not big 10 years ago. So they're not necessarily a lot of them, but that's kind of how it works. But anyway, let's turn to Canadian Solar though. Yeah, I can't really dive into the issue that they had too specifically on that, or I mean, I could maybe try to pull up a statement that they had. Let me pull up in their investor relations. I'm sure they put out a statement on it. Maybe I can take a look at that real quick, but I can't really get into the nitty gritty relating to that issue too much, but we can take a look at where they are in terms of value today comparative to where they were previously. So, okay. Canadian Solar, oh yeah, these companies that are unprofitable. So coming back, at least taking a look at kind of like 7 years or so worth of their multiple, you can see in general they traded around an average of a multiple of maybe 10 to 12, depending on which multiple we're looking at. No one needs to go through the IRS stuff unless you want. Well, I mean, I'm legitimately somewhat interested in the company. I thought it was at least a kind of an interesting company with a decent history in an interesting area and in a industry that I haven't really looked at too much of. So point is, like, if this was to become an interesting company that maybe had a good value to it, I would have been interested in maybe making a model for it. So I didn't expect it to drop so much so quickly, not so long after having done a basic valuation of it. But I threw together a basic value for it for a reason. Like I don't throw things in here just cause, right? It's like I do them because I think they maybe have potential. So it ended up here because I thought it had potential, and then it dropped, making itself look even more potentially interesting just so very, very fast. So I'm very serious that I want to look at this. I don't know if I'll make a whole model for it or if it'll ever get a video. That kind of is like the next, you know, layers of it. But the point is, yeah, I might as well pull up in their investor relations, see what's up with this, because that really does make a huge difference to it. I have my valuation that I came up with right here, which if these assumptions that I put into this valuation are even halfway good, then it would be a buy right now, right? It would be a pretty good buy right now if these are halfway decent assumptions. Now, I think these were somewhat bullish assumptions that I had put in here, admittedly, so it probably does have to be pulled back a bit. But hey, maybe it's close to fair value now, you know. And even then, that might mean that it's worth making a whole model for. So anyway, I'm on their investor relations, looking at the news releases. I don't see a specific. They don't have like a specific article about it unless they just talked about it in the quarterly release. Let's see, CSIQ dumping. Let me just search for it. TGLS after drop, Pavel. Hey man, I appreciate you watching. You do not have to interact if you do not feel like it. You know, I appreciate you watching in whatever way you do. But hey, but if you also decide you want to pipe in, that's also appreciated always too. So yeah, it's like we need more lurkers, honestly, right? It's like let's see. So yeah, I'm trying to find let's see, one article I think it's gonna talk about it. Yeah, I don't know. Maybe I'll have to find that afterwards. I was hoping that maybe their website would just have like one release where they talk about it. Maybe they have an 8K where they talk about it. But yeah, we'll just continue to talk about it here. So anyway, the point is looking at the multiple where they typically traded at, and I would point out that this is also through relatively low interest rate environment, right? So this is the low interest rate environment, and they were trading at a multiple of like 10 to 12, depending on if it's EV to EBIT or PE ratio. Which is to say that they're more of an equipment type multiple, right? This is a very industrial manufacturing type multiple, not a services type multiple. Even though, yes, they are in the semiconductor space, they're much more of a manufacturer than just a pure design play. And it also has to do partially with just the capital structure of the industry, because I do believe they do quite a lot of design as well. But the point is, it's not going to be exactly the same as like other semiconductors, even though you're going to see them listed with semiconductors and semiconductor equipment. They're going to be much more of direct manufacturing, and they're going to get similar type margins along with that. So that's one thing to keep in mind with this, is that you can't necessarily compare them apples to apples with other companies that might be grouped with them because of that industrial grouping. Look at their EBIT margins. You can see, yeah, throughout the kind of average here, it's probably like what, 5 to 6% on average across here. We have a high point of 12, a low point of 2.5 or something like that. So yeah, kind of in this like 6 to 7 range, more like 5% in the last few years on average. So relatively low margins. It really comes down to just the interestingness of the industry itself and the growth path, because yeah, it's had very, very good growth. It's expected to have continual good growth. A decent amount of analysts backing it up too, so it's not just a couple of people that might be totally wrong. They're expecting 20% capping off this year. We'll see if that actually lands it on it. 15, 16% next year, 10%. And who knows, maybe these are going to get revised down because as a result of some of the negativity. I imagine they probably already did a little bit. And usually this website's pretty quick about updating these within a day or two. So I would assume that this is already taken in some of that decline, some of that negative sentiment into account. Not 100% sure on that front. But yeah, then yeah, we went from 40s now down to 27. 40s down now down to 27. Definitely very, very fast. Very, very fast. Come over to the financials again. Ratios. Yeah, I've seen Pavel's been around. He's been around here and there. I've definitely seen him comment here and there on some other days. Yeah, he's been around. But yeah, so also take a look at their liabilities. That's kind of, you know, one of the other things I often try to take a look at. Just a quick snapshot. What does their balance sheet typically look like? This balance sheet, whoops, I kept the EBIT by accident. This balance sheet has actually been improving over time. It was in actually kind of relatively high liabilities level. It's been improving, not a massive improvement, but it's been slowly coming down over time. It'd be nice if we could see this continue because it's still kind of in relatively high territory. Not necessarily super low, not necessarily incredibly high either. It kind of comes down to the industry and stuff like that, but they do have low EBIT margins as we were talking about. So the lower your EBIT margins, the more sensitive that's going to be, right? Because earnings before interest and taxes means you're going to have to pay your interest after that. Now, obviously, again, like that depends on whether it actually is interest bearing or not. I was looking at total liabilities, the same discussions we were talking about before. It comes down to whether or not that's actually debt or not. But in their case, it is actually debt. There is actually some real debt there. Not necessarily an incredibly huge portion of it, but a decent amount of it is actual debt. So they got to be careful about their liabilities, but they are slowly bringing their liabilities ratio down. And that's definitely one of the things I would say is a concern for them, is that they have to grow on but they're levered under the assumptions that they are going to grow. It seems like their growth path is pretty well counted on, pretty well you know, people seem to believe in it pretty strongly, which is one of the reasons, like I said, I was kind of interested in them. Is like, it seems like they're well covered by a lot of analysts, and a lot of analysts seems to believe they're going to grow. That means maybe that industry actually is possibly interesting to look at. So the question then became about the valuation. So yeah, I don't know. We'll see. Maybe I'll take a closer look at it this week. I'll take a look at that dumping charge that they got. Sometimes dumping charges are a big deal, and sometimes they're not really much of anything. So it could be a great buying opportunity. Hard to say. For transparency, I only read about the dumping fee thing on Reddit. I searched and can't find that. But I think that there is something somewhere out there that caused it. My bad if I'm wrong. Oh, okay. Well, I mean, possibly that's possibly the case, but nonetheless, there's something caused it, right? Like I said, I even said so when I commented on it to Mr. Beast in the Discord. I said, hey, assuming whatever caused this doesn't affect the long-term perspective, it could be a buy now. That was pretty much almost verbatim what I said. So it could be something, could be nothing. And I don't know, it could be that there's more, it's just like short-term concerns about these hitting some of these targets, right? High growth rates are great if you're looking for a company that's going to have a good growth path to it. But if everybody is baked those growth rates in, then that means that small adjustments to the assumptions of what's going to happen to those growth paths is going to have a huge compressing effect on the valuation. So it's possible that maybe it's just slowdown concerns that's causing it. It might not be any major substantial thing, but yeah, I'll look into it though. Yeah, it was a big drop all in one day. Something caused it, right? It doesn't come from nowhere. So any others? Another one. Oh, you want to take a look at TGLS? Pavel, you brought that one up. Let's take a look at that. Technoglass produces, markets, installs architectural systems for the commercial, residential, construction industries in Colombia, United States, Panama, and internationally. Laminated, thermo-laminated, thermo-acoustic, tempered, silk-screened, curved, and digital print glass products. Aluminum products. Glass settings, windows, doors, spatial separators, related products. Curtain walls, floating facades, stick facade, windows and doors, interior dividers, commercial display systems, hurricane-proof windows, and other products. Yeah, I know this one was brought up a few times in the chat in some of the other previous lives. I think I maybe looked like briefly at like some key statistics, but I don't think I looked closely at it. But I know it's been commented a few times before for me to look at this one, so I was like, we'll take a look at it, especially since it obviously fits in with some of the themes we talked about. I'm pretty sure Jeff, you yourself, I'm pretty sure have mentioned it before, maybe, as other companies that come in with like the building products and stuff. Yeah, very, very interesting set of products. Could be very, very interesting. Fits in with some of the other some of the themes we've been focusing on. focusing in on some of its statistics here. Very, very low dividend yield, less than 1%, but miserably low payout ratio. That's what we like to see. Next trailing 12 months, low PE of 8. Could be low depending on how we think about the cyclicality of its earnings, of course. Similar topic that we were saying before. Gross margins 51, 52%, EBIT margins 36%. We'll see about the cyclicality there as well. ROA 24, 25%, same thing. Market cap 1.6 billion. Similar enterprise value. Looks like they basically have no debt or no cash or netted amounts. Relatively low short ratio. Relatively high forward growth rates, which fits in with, I think, expectations of the growing industry. Very, very solid looking numbers all around on the kind of the key figures here. Hopping over to the estimates. No, not you, Jeff. Okay, yeah. No, I mean, hard to tell. You throw so many tickers at me sometimes. I can't. As I've said on other ones, like it's hard for me to remember where I hear tickers from. It might have been Mr. Beast that was talking about it. I'm not sure. And it might have been Pavel before as well. Like I said, it's like I've definitely seen him here before. He's definitely been with us for some time. Just not necessarily every time, right? But yeah, so I don't know. Maybe it was just him that was throwing it back and forth. But I've definitely seen somebody throwing this one at me before. But yeah, interesting. PGTI, yeah, I think that was the other one that you had talked about. This one, yeah, some of those key figures I was just looking at definitely look very nice. We'll see how we feel about everything with it, but some of the figures look pretty good here. Interesting. The forward revenue CAGR says here 13.6%, and then if you kind of come over here, I think it's baking in most of 2023, which obviously we're kind of halfway through. So then it looks like we're getting a bit of a slowdown in terms of the revenue for 24 and 25, but at least we have a 25 number. That's nice, even if it is only coming from one person so far. Then we have EBIT numbers, which are growing as well. Remaining EBIT margins kind of in this mid 30s range. So they don't seem to think that that's overly of cyclical reasons, even though if we look backwards, it looks like we're seeing teen EBIT margins. So I would maybe be skeptical of these EBIT margin levels. That's something that we would probably be a bit more conservative on in our own assumptions. Similarly with free cash flows, looks like they're kind of assuming the free cash flow margins are just going to be super high for the next few years, which maybe that's true, but we'll see. Before we go to valuation, let's look at the financial ratios. With this growth, I'm really surprised they haven't diluted in 3 years. Jeff, well, that's good to hear. Yeah, high growth. You might have expected to see some issuance, similarly with the other one. The faster a company's growing, the more forgivable dilution is, right? That's just how it works in general, or at least in my perspective. That's how I think about it. So look at these gross margins versus the EBIT margins. Pull it back. Yeah, so we're seeing gross margins really accelerating in 2020, 21, 2022, and then EBIT margins are carrying upward with that. And that's, in my opinion, a telltale sign of unsustainability, personally. So I would expect that since the actual gross margins prior to 2020 didn't really peak higher than 37, I would assume that you would likely see EBIT margins actually peak somewhere around wherever that peak level is. So EBIT margins, in my opinion, are probably more likely to be 15 to 20%, more likely than 20 to 30%. But that doesn't mean that this doesn't still look good, right? Well, it all comes down to how they're priced relative to that. Yeah, see, Jeff, you're going with the similar thoughts, and it seems like even if margins reverted lower, they were almost 20% before the last run. Yeah, so it's like I'm saying, it's like I would expect maybe sustainable margins would be like 15 to 20%. If I had to guess, I would have to look at their cost structure to learn more, but based off of just kind of the general trend between gross and EBIT, that's how I like to think about it. It's like, how much does gross look like it's above average? That's the amount I would expect it to revert, because the unit costs can only be so cheap. That's basically my argument there. You can maybe make your corporation portions of your operations be more efficient, which is kind of the difference between the two. The non-unit based costs and stuff like that, you can maybe make that more efficient, but the unit costs can only get so efficient. So I would expect that to maintain more of a typical average. And admittedly, those statements too aren't necessarily ultimate fail safes. There are some companies where you could see a sustainable growth in growth margins, but I would see that sustainability starting much earlier rather than seeming like it just kind of was in a cyclical behavior right up to 2020 and then accelerating. But yeah, so maybe 15-20% sustainable margins. Looking at the liabilities, let's take a look at that. Liabilities were much higher in the past, and then they have been coming down. So this is what we like to see. This is good. This is looks like they've made some very, very strong sustainable bringing down of the liabilities, which was actually probably them just bringing up the assets. That's one thing you always have to know about this, is that it's actually probably more likely that they just grew out of the liabilities more likely than not. But that's good. That's still good. That's always good too. Jeff, you know what's interesting? Their tax rate dropped from 50% in 2017 down to low 30s. I wonder if that is part of the margin increase. That doesn't make sense, because we were looking at EBIT margins. EBIT is before taxes. So keep that in mind. This is pre-taxes. That would affect their net margin. So I imagine their net margins have probably exploded even more. And because that would be part of that calculation. But EBIT margins are pre-taxes, so that wouldn't be part of that calculation. But yeah, if we do pull up net margins though, it's gonna be even more. So let's get rid of abilities, and we can get rid of the gross margins too. Yeah, so net margins, we even have negative years in there. But yeah, look at this. Net margins looks like maybe 13%, 1% on average, maybe 6 to 7%. 6 to 7% prior to the changeover, and then they exploded up to 21-22%. Yeah, gotta keep in mind, it's like, yeah, when we like EBIT margins, operating margins, because yeah, they're pre-tax, pre-interest. It just tells us the margins of the operations. Yeah. But that is interesting though, that because that's independent. You bringing that up, so going from a 50% profit margin down to 30% profit margin, that's independently interesting. That is interesting on its own, actually. Because that kind of begs an interesting question of why would that happen. Now, one thing I'll point out is that you do get to roll over your losses operationally against your taxes, right? So if they had losses previously in the past, and they probably had those saved tax assets on their balance sheet, then that's probably why their tax rate was much lower. They might have been able to use some of their deferred tax assets to shield their income in future years. So that's probably why it happened, if I had to guess. And then the question would be, how much can they continue to do that? Let's see, let's look here. So deferred tax assets, we had some tax assets, about 5 million worth in 2018, 2019, and then those went away. So it looks like that's what happened here, but that doesn't really look like a huge number, because the number you're talking about, I would imagine, would be a bit larger than that. Well, 2018, 2019, maybe that might, yeah, that might count for the difference there. The cash conversion cycle / days sales outstanding are like 200 days. I don't get how they're doing what they're doing so well in that circumstance. Well, let's take a look at that. Cash conversion cycle. It kind of depends on companies. So your days sales. You might be using a slightly different version of the calculation if you're getting 200, but they had 200 in 2020, or close to 200. I think there is a few slightly different versions of ways you can calculate this. So if you're getting a slightly different number, it might be because of slightly different ways to calculate these things. It comes down to like where you line up the periodicity of it. So if your number is a little bit different, don't freak out about it. But the point is, the trend is what matters, right? What I'll say about cash conversion is that the absolute number doesn't necessarily decide how bad the situation is, because it might just be a situation depending on their industry, and also might depend on their position against their competitors and their suppliers and their customers and stuff like that. It could be that they're just the smaller gorilla in the room relative to their customers, and so their customers are allowing them to do something like that. Sorry, mine ended up in operating cycle, a calculation of something. But yeah, like I said, like I wasn't gonna get into the nitty gritty of it or make a huge deal of it, because like I'm aware that there are slightly different ways to calculate a lot of these ratios and these metrics, right? And so people will have slightly different versions of the number or whatever. Maybe like some people will use cost of goods, some people will use sales. There's slightly different versions, but yeah. Doesn't make a huge difference, but Pavel, they have very cheap labor in Colombia, cheap transportation to Florida, where they have big market share, and now they're slowly expanding into other countries. Interesting. Okay. Jeff, yeah, that's a great point. Could just be slower to move product businesses, improvements or improvements. They look like a company I'm going to model. Yeah, like this definitely looks like an interesting company to throw on the list of ones that kind of fit within the framework of some macro pictures we're very focused on. It has good financials, good growth set up for it. I have specifically been avoiding the valuation part of the discussion. We'll get there, right? I always try to do that, frankly. I try to get to the valuation part of it last. I don't always remember to do that. Sometimes I skip over to it preemptively, but I try to look at all the fundamentals first, and then we go look at the valuation. But yeah, so we'll look at that, which I remember on the front page, it said it was forward of like a multiple of 8. So it looked like it was sort of cheap, but we'll look at its valuation history and see if that really lines up, right? But yeah, the point is this could be a very interesting company. We'll add this to the list of ones to dive a little bit closer on. But yeah, very much the cash conversion cycle, getting back to that point though, the cash conversion cycle is a very, very context dependent thing. It doesn't necessarily make a company bad if they have a really large cash conversion figure, as long as that cash conversion figure is relatively stable. So like what we were actually sort of seeing it on there. Sorry, I'm bouncing back and forth a whole bunch, but we can see it right here. It's like, this is pretty stable. It's drifting upward over these years right here. So I would have been, if I was part of the company during this drift upward, I would have been pointing out the drift upward, but this isn't even like a super bad drift upward. This is kind of a slow drift upward. And I will say even 200 is not a terrible number. Maybe once it gets up into 200s, you're starting to be concerned. Up towards 300, definitely starting to be concerned, because that means now you're almost like a year behind on your sales. But half a year to get your cash isn't the worst. I don't know. Like I said, it all depends on your personal perspective. Because I mean, it's the same thing with like a liability ratio, right? Like some people think a 50% liability ratio is horrible and you don't want to own the company, whereas some people think 100% liability ratio is okay. Just not starting to become bad, but not necessarily too bad, right? So it's one of these things where it kind of depends on your personal taste, how you think about cash conversion cycles. I think the trend matters more than the absolute number, and then the absolute number itself is very case dependent on the industry, and it's case dependent on their suppliers and their customers, because their supplier or their customer might simply just have more wrestle power when it comes to how long they can take to pay. That doesn't mean that they're not going to pay. See, the problem when you worry about a growing cash conversion cycle is that you worry that they're not actually going to get the cash. If they are going to get the cash, which is what you would have if you have like a consistent 180. If your cash conversion cycle was 180 days every year and it never changed, you wouldn't worry about it. You wouldn't care, because it's never changing, right? It would just means you just have to factor that in. You just have to factor that part in. But so yeah, that's what I'm saying is like, the trend matters more than the absolute number. And the trend, I would argue, is kind of in a somewhat good direction for these last few years. So that's yeah, maybe almost another point in their favor to a certain extent. But yeah, let's take a look at valuation. Let's finally get over to the fun part, I guess. Take a look at them over the last year. Oh, how nice to have a company where we can look at the long-term valuation trend and it not have a period where they were unprofitable, dropping their multiple to negative territory, right? Isn't it so nice when we can look at almost 10 years? It's not quite 10 years, it's more like 8 years, but 8 years of a pretty multiple chart. Chef's kiss. But yeah, anyway, multiple average about 9 for an EBIT multiple, about 12 for a PE. That's starting to be a pretty substantial change there. But it is what it is, a little bit there. And then comparing that against where they currently are, that kind of makes them seem like they're not necessarily super cheap, but a little bit cheap, because it's a little bit of the same difference, but kind of making the scale difference between it. So we have going from the EV to EBIT from 8 to 9 now down to like a 6 versus the 12 down to 8. So it's about 1/3 as cheap as it's been on average. But then we have to take into account interest rates. And so interest rates, I would say, might actually account for that total distance. So you could maybe argue that they're actually trading on average about as cheap as they typically have if we're accounting for interest rates. But like I said, you also have to take into account growth rates. So past growth rates compared to future growth rates as well, probably have lower future growth rates, which means you would almost expect them to be cheaper. So I don't know. You could argue that they're a bit cheap right now, but you could also argue that they're kind of fairly priced right now. And you could even maybe argue that they should be a little bit cheaper if they're going to have lower growth rates. But the rest of the numbers, the fundamentals of the numbers, the balance sheets, and the rest of that all looks really good. So the point is, you wouldn't necessarily even have to argue that they have to be super cheap. They might be a relatively quality company, which fair value could be relatively nice for them too. So, like, good company. Thanks for mentioning it, Pavel. I'm actually gonna here. Let me jot that one down actually, just in case I forget. 'Cause yeah, I would like to maybe take an extra look at that later. There's never any guarantees of what happens when I take a look at it later, so don't expect a video. Is basically what I'm saying. It's like don't expect the video necessarily, but maybe, who knows. It's kind of like a process. You guys suggest tickers. I hear the ticker 4 or 5 times. After I hear a ticker 4 or 5 times, it gets noted down here. I stare at it on these lists for like a week or two, and then eventually it gets turned into a basic valuation. Basic valuation sits here for anywhere from 1 week to 3 months, depending on how cheap it is and how good the opportunity is. And then maybe it gets turned into a model. And if I like the model and felt like I understand it well enough, well, then that gets made into a video, right? So many steps, but yeah, thanks for the suggestion though. Maybe I'll take a closer look at it over time. Let's see. Maybe we'll call that for today. About 1 hour and 20 minutes. Yeah, well, I think that'll be good for today. So yeah, all right. I appreciate you guys keeping me company here today, giving us the suggestions. That was pretty fun discussions, talking about a few companies here. As I was kind of saying, throughout the live at various points, I'm expecting to put out my Encore Wire video this week on Friday. So to keep an eye out for that. Watch it, like it, share it, and all that stuff. Please like the stream if you haven't already on the way out. If you're watching live on the replay, it would be super appreciated. Throw me more suggestions for companies you guys want to see in the future. As I was saying here, we have the whole process. I'm always looking for more companies, more stuff to take a look at. And as I also had said, I'm doing more and more analysis of the copper space. I expect to do an overview of the copper industry for our live discussion next week. So you guys can keep a lookout for that as well. We don't usually have the topic of the live shows announced ahead of time, but I kind of have a set of ideas kind of on the forefront for the future. So for the time being, I do have that kind of to mention to you guys today. So I'll catch you all next week. All right.